Welcome to this video briefing, Operation Double Tap. We're analyzing the latest market intelligence for the Independence Week edition. Please note that this is not financial advice. In this video, we break down the tape, the current wave count, key catalysts, and an audit of market data. We are examining everything on the table to provide a comprehensive look at current conditions. Here are 6 critical points to understand before Monday's open. The bullish count is dead. Subwave 2 is likely complete. The Dow is acting as a decoy. The labor market is showing cracks. Crude oil has hit a key reversal, and market leverage remains at record highs. Thursday's session saw a record close for the Dow Jones, while the S&P 500 flatlined and the NASDAQ 100 faced a significant 1.61% decline. This divergence, with growth names selling off into index highs, is a classic warning sign of potential market tops. Our base case follows a bear path where the June 2nd peak holds, resolving into a crash wave 3. Alternatively, a delayed bear case is possible, but only if the June 2nd peak is not breached. The underlying theme remains clear. The June 9th low is likely in danger. In Act 1, we explore the Dow decoy. We analyze how a record close in just 30 stocks can effectively mask broad, tech-led distribution across the wider market. While the headlines celebrated the Dow adding 600 points, the reality was a sell-off in tech, AI, and semiconductors. Money rotated into the 30-name index, masking the damage occurring in the growth sector. The mechanics are simple. The Dow represents a tiny fraction of total market capitalization. When the narrowest index hits new highs while broader indices do not, it's not a sign of strength, but a tactical decoy. Non-confirmation between major indices is a hallmark of market tops. When the S&P, NASDAQ, and Dow peak at different times, it signals that the broader market is failing, while headline indices continue their momentum. The tech sell-off beneath the headline is significant. As leadership groups like semiconductors crack, it suggests that supply is gaining control, even when the Dow's performance suggests otherwise. Our divergence map shows 4 indices telling 4 different stories. The takeaway is clear. Ignore the singular headlines and trade the actual market structure. In summary, treat the Dow's record as a sentiment indicator rather than a trend signal. Focus your attention on the S&P wave count and the NASDAQ's confirmed bearish patterns. Moving to Act 2, we examine the wave count. We will look at the S&P 500 from the June 2nd peak, focusing on the 5-leg push completion and the development of the current crash setup. Since the June 2nd peak, we have seen a month of sideways volatility, often mistaken for consolidation. In technical terms, this is frequently a topping process, characterized by lower highs and fading strength. Finally, we analyze the, quote, leading diagonal. These structures appear at the start of powerful, often violent moves. A messy wave 1 followed by a deep wave 2 is a classic fingerprint for a potential market crash. In this section, we analyze wave 2, which acted as a deceptive rally to rebuild false hope among the crowd. Multi-point divergence at the trendline resistance indicates this phase has likely concluded. We are currently looking at a nested 1-2-1-2 structure, which often serves as a precursor to a sharp decline. With 2 layers of trapped buyers, the release of subwave 3 could be highly directional. Thursday's market action provided a clear signal. A fizzled rally, followed by a sharp drop and a flat close at a lower high, suggests that the smaller subwave 2 has reached its end. Crash wave 3 represents the, quote, kill zone in Elliott wave theory. Characterized by gaps and trend-following behavior, it is the most powerful segment. We are monitoring for its full release. To confirm this outlook, we use a simple checklist. A lower high is set, and a break below the June 9th low will define the trend. When that level falls, the crash wave targets become active. The bullish count is now invalidated, as recent price action violated the necessary rules for an impulsive extension. With only bearish scenarios remaining, our focus shifts to position sizing. In our alternative bearish count, the market might undergo a more complex wave 2. Regardless of the shape, the June 2nd peak remains the ultimate invalidation level. We are keeping a close watch on overhead gaps at 7,584 and 7,610. These levels serve as potential magnets only if the correction continues to extend. To the downside, the 7,475 gap has been filled, cleaning up the near-term map. However, numerous unfilled gaps remain below, representing air pockets where support may be non-existent. Finally, we observe a potential diamond reversal pattern and a backtest of a broken trendline. Both suggest that the exit door is clearly marked for those watching the charts. Looking at the candles, we have indecision on the S&P and a confirmed reversal on the NASDAQ. We await confirmation followed by follow-through. In Act 3, we turn our attention to the NASDAQ and the impact of the SpaceX IPO, which marks a significant event for market distribution. The NASDAQ peaked on June 3rd. The subsequent decline and recovery are being mapped as a standard wave 1 and 2, but the June 2nd peak is our absolute limit. A hidden bearish divergence on the NASDAQ has already paid off, resolving into the recent sell-off. Momentum indicators are currently rolling over across the board. On the 60-minute chart, the 50-period moving average has crossed under the 200, signaling a deterioration of trend mechanics. The next lower low will solidify this downtrend. In this scene, we analyze the distribution pattern around the IPO event. You can see the progression from the S&P peak on June 2nd to the NASDAQ peak on June 3rd, leading into the distribution phase where tech was sold into the hype. Post-IPO, SpaceX saw a 51% rally on euphoria, followed by a 34% collapse. The current position shows a weak bounce, indicating a distribution sequence. SpaceX and the NASDAQ appear headed significantly lower. The narrative versus the reality. While the market hyped the IPO as a bullish catalyst for a melt-up, the tape shows distribution occurred both before and after the event. Maximum hype events often serve as exit liquidity. Regarding the forced buying event on July 6th, index funds were required to purchase SpaceX at the open. We treat this inclusion-related pop as a temporary gap fill, not a trend reversal, as the structural bearish case remains. We are watching the 30,347 gap. Price recently missed filling this gap by only 18 points before turning down. A failure to fill this gap here signals a failed retest and a potential lower high for the market. A bearish harami pattern on the NASDAQ is now confirmed. We are waiting for follow-through, specifically a decisive break of the 50-period moving average. The market is currently resting on this critical level. Our momentum dashboard reveals a uniform rollover across 6 key indicators. Stochastic, rate of change, RSI, and moving average alignments all suggest the market is positioned for a significant drop. We see a familiar pattern emerging in the NASDAQ, similar to Bitcoin's recent 30% drop. The technical warning signs, specifically the MACD and price oscillator, are echoing the same pre-collapse signature. Moving to Act 4, we analyze cracks in the labor market. A 50% miss on job creation, combined with participation rates at 50-year lows, reflects the same negative trend observed in the 2007 recession playbook. The latest jobs print of 57,000 was only half of expectations. Although the unemployment rate ticked down to 4.2%, the initial relief rally fizzled, suggesting the market is no longer finding support on bad news. Labor force participation has dropped 30 basis points, reaching levels not seen since 1976. This is a sign of long-term deterioration, as job seekers give up and leave the labor force entirely. We are tracking the, quote, revision game. May's job report was revised down significantly. History shows that today's headline numbers are often adjusted lower later. We focus on the trend of these revisions. The 4.2% unemployment rate is misleading. Because the rate is a ratio, a shrinking denominator, caused by people leaving the workforce, makes the percentage appear better, while the underlying health of the labor market worsens. Comparing the 2023-2024 period to the 2025-2026 data shows a clear regime change. The consistent growth of the past is being replaced by deceleration and negative prints, signaling a broader economic shift. Finally, we compare the current environment to 2007. Just like then, negative payroll prints are emerging, serving as a warning of the cycle ahead. We expect the current data to follow that established playbook. 2008 provides a clear template for what a negative labor market looks like. In 2008, every single monthly payroll print was negative. Today, we're seeing scattered negative prints, downward revisions, and denial, suggesting we may be on a similar path as a recession takes hold. What accelerates the economic decline? Often it's the coupling of labor deterioration with a potential oil shock. An oil shock taxes consumers and businesses simultaneously, turning hiring freezes into layoffs. Meanwhile, manufacturing employment is showing its sharpest fall since 2020. The verdict, the warning is flashing. We're seeing deteriorating payrolls, collapsing participation, and manufacturing employment at crash velocity, an identical combination to what preceded the 2007 recession. Equity markets often top before recessions are declared, and this data is arriving right on schedule. We are entering Act 5, titled The Fed Trap. While 9 voters on the FOMC may want a hike, history suggests jumbo cuts are coming. Both perspectives can be right, depending on the sequence of events, as the Fed faces inflation scares at market tops. The FOMC minutes for July 8th are critical because they come from the meeting where the committee's bias turned hawkish. They are being released into a market already rolling over, acting as a potential catalyst for a sell-off that third waves often use as a scapegoat. The latest dot plot shows all 9 voting members expecting a rate hike, with 5 projecting 2 hikes before year-end. However, despite market pricing for a hike, the HPT view is that it may never come, as the economic reality points elsewhere. Looking back at the 2000 market top, inflation was running hot, leading the Fed to hike by a half point in May. But the market had already peaked, and after some chop, a 20% crash ensued, followed by emergency jumbo cuts by January 2001. The 2007-08 top followed a similar pattern. Inflation was rising with an oil shock, but the Fed didn't hike. Even so, the market peaked in October, eventually forcing the Fed to panic and initiate jumbo cuts by January 2008 as the market broke down. The common thread in 2000 and 2007 is that both tops occurred during inflation scares. In both instances, the Fed ended up choosing to save the economy through jumbo cuts, not because inflation was beaten, but because the market and the economy broke first. The Fed faces a difficult choice: fight inflation by hiking into a weak market, or save the economy through cuts, despite rising inflation. History shows that when push comes to shove, the Fed prioritizes the economy. Every hawkish word until then is just the setup. Many argue the Fed can't cut if inflation rises, but history contradicts this. In 2000 and 2007, the Fed initiated jumbo cuts while inflation was still rising. When forced to choose between fighting inflation and protecting the economy, the Fed has historically chosen the economy. The endgame typically involves a deflationary bust. The sequence begins with an oil shock, leads to Fed paralysis, then a market break that forces panic cuts, and finally a downturn that kills demand and collapses inflation. Inflation is the fuse, not the bomb. The next 2 weeks serve as a gauntlet, starting with the July 8th FOMC minutes, followed by CPI data on July 14th and 15th. Each of these events poses a risk of market volatility as investors digest the internal debate at the Fed and ongoing inflation data. In Act 6, we examine the oil shock setup. With a recent reversal at the 200-day moving average and commodities historically peaking last, the market is navigating complex signals. We're looking at potential new highs in crude and gold's wave 5. The war gap in crude oil was filled perfectly at 67. This was the final untested magnet below, completing a corrective script that saw the market lose the 200-day moving average, fill the gap, and now potentially prepare for a reversal. DeMark's 9-to-9 reversal pattern is our key fingerprint here. We've seen 2 back-to-back exhaustion counts into support. This suggests the recent downward trend is reaching a critical inflection point, as the market aligns with gap fill objectives and multi-point technical confluence. The current market setup is defined by a stack of bullish structures, including nested bull flags and a falling wedge. When these patterns stack together, they point in one direction: up. This confluence of bullish signals is rarely an accident. The 200-day moving average acts as our critical validation line. While we have already filled the gap, reclaiming the 200-day is the final step for confirmation. Respect the setup, but trade based on the confirmation. Momentum divergence is providing a solid floor for this reversal. While price made new lows, momentum oscillators refuse to follow suit. This disagreement between price and momentum is often where significant market bottoms are born. There is an iron law in commodity cycles: they are the last to peak. Crude oil, in particular, often marks the final stage of the cycle. If the stock market has already peaked, history tells us the commodity cycle's peak is still ahead. Looking at the 2007-08 sequence, there was a 9-month lag between the equity market peak and the top in oil prices. This delay is a consistent feature of past cycles, and it remains a vital part of our trading playbook today. Even the year 2000 tech bubble followed this sequence. Despite oil being relatively inexpensive at the time, it still peaked after the stock market. When a pattern persists through its weakest tests, it becomes a law you cannot ignore. A key signal is that crude oil did not confirm the S&P's peak in June. In prior cycles, like 2000 and 2007, crude reached new highs after equities topped out. The absence of that late cycle high suggests it is still to come. Gold is also part of this cycle, likely carving out a wave 5 advance to new all-time highs. Historically, gold leads the Fed's reaction, front-running jumbo cuts before they occur, while crude oil peaks on the shock itself. Public narratives about an Iran deal are currently serving as a distraction. These stories often surface precisely at technical bottoms. While the headlines suggest oil should drop, the chart indicates we have reached a major support zone. Oil isn't just a side trade, it's the mechanism that forces broader economic dominoes to fall. The transmission goes from an oil shock, through rising CPI, and ultimately into the Fed trap that forces their next major policy move. Our playbook for oil is straightforward. Below the closing gap on a daily chart, the current setup pauses. However, regaining the 200-day moving average starts the clock for a potential oil shock cycle. Now we transition to Act 7, an audit of recent claims regarding the economy. We are measuring high-profile political and economic assertions against the actual, hard data, covering everything from manufacturing jobs to trade policy and inflation. A common claim is that more factories are being built than ever before. Yet, data shows construction spending has been falling since mid-2024. The surge was driven by policy acts that are now seeing those projects reach completion. The factory build-out phase is nearing completion. While this stage was inflationary, the completion of these facilities suggests a disinflationary wave ahead. We are trading the short-term inflation scare while preparing for the long-term supply reality. Let's audit the claim regarding manufacturing jobs. While the narrative often points to a boom, the data paints a different picture. Manufacturing employment has actually declined by roughly 100,000 jobs since the inauguration, with recent PMI surveys showing the sharpest employment contraction since May 2020. Next, we examine the claim that more people are working than ever before. This is a technical truth due to population growth, but it ignores the labor force participation rate. The rate continues to fall, reaching levels not seen since the 1970s stagflation era, signaling significant underlying weakness. On the claim that 401ks are up 80 to 90%, the data suggests a stretch. The S&P 500 is up about 24% since the inauguration, with a significant portion of that gain tied to geopolitical relief rather than broad economic policy. Such concentrated gains don't reflect typical retirement accounts. We've observed a recurring pattern of trading activity appearing around major policy announcements. In February 2024, advisors purchased Axon stock weeks before a major contract was awarded. Similarly, in July 2025, a massive investment was made into tech firms on the same day the AI action plan was released. With over 21,000 trades made across various accounts in 2025 alone, the sheer volume of activity, averaging 80 trades a day, is notable. While no one alleges the former president is placing these trades personally, the timing and correlation of these actions with policy releases continue to raise questions. Regarding the assertion that 40 to 60% of chips will be made in America by the end of the term, the industry outlook is more modest. Projections indicate fab capacity reaching about 14% by 2032. While this is growth, it falls far short of the 40% figure. TSMC's Arizona plant and the government's equity stake in Intel are both tangible results. However, they were built on foundations laid during previous administrations. These wins are real, but they are currently being repurposed for political messaging, while the original programs themselves face public criticism. Regulatory access is emerging as a new asset class. We see patterns like OpenAI and others floating stakes or making donations, potentially as a hedge against regulatory intervention. Traders must account for this. Proximity to administration favor is increasingly a primary driver of corporate tailwinds. The claim of total military victory over Iran is contested by current operational data. Assessments suggest that a majority of Iran's naval and air assets remain intact and operational. Furthermore, enrichment activities continue, suggesting the geopolitical situation remains complex rather than fully resolved. We often hear comparisons to Herbert Hoover, but history carries lessons. Hoover's economic struggles were compounded by trade barriers and interest rate hikes. Today, the combination of tariff-related pressures and conflict-driven inflation creates a similar environment, where the Fed's independence faces unprecedented stress. Now we shift to the final act, the risk dashboard and playbook. The current landscape is defined by low cash levels and record-high leveraged AUM. In a system where everyone is already fully invested, there is no marginal buyer to support the market if a decline begins. This high leverage acts as an accelerant. Should prices slip, margin calls will force selling, which triggers further declines and more calls. This reflexive loop is the primary risk factor for the market, turning what might be a minor correction into a significantly more volatile event. The GDP Now estimate from the Atlanta Fed has collapsed from 4% down to 1.2%. This sharp decline, driven by falling labor participation and slowing manufacturing, highlights an economy losing momentum, just as it enters a period of high volatility and peak positioning. Looking at our scenarios, we have a base case for a bear path as technical levels break. We also track a delayed bear alternative, where current highs hold, providing a better entry point for the same ultimate decline. Our invalidation remains a close above the June 2nd peak. Our discipline is clear. Follow the rules, not the opinion. Two paths lead downward. One leads out if invalidated. Having a map for every outcome is how we stay consistent. For more deep dives and live updates, follow our work through our linked community channels.